Welcome to another episode of Cannabis Tech Talks. My name is Andrew Ward. I am the managing editor at Cannabis and Tech Today. Today, I am excited to be joined by LeafLink analyst and author of the inaugural LeafLink U.S. Cannabis Market Report for Q1 2024, Ben Burstein. A lot of great information in there, and just the way the cannabis market moves, we've already got some developments that have already been addressed, such as the DEA going on in the U.S. market over here. So, really excited to be chatting with Ben about the latest numbers as well as some of the other movements in the market. Ben, thanks so much for joining us. How are you doing today?
Everything's great. Thank you so much for having me, Andrew, and thank you so much you do for everything for our industry. You are such an important piece of the information everyone gets, including myself. So I'm just really happy to be on with you.
Oh man, that is way too kind of words for me, but I appreciate it. Thank you so much. Yeah, Ben, kicking it right back to you. You guys are providing so much great data. One of the leaders in the marketplace. Obviously LeafLink being a retail platform, serving a lot of businesses and customers, but also providing a ton of great data along the way. With the Q1 2024 market report being no different. Just some of the big takeaways I remember seeing on here was that the national cannabis sales peaked at, what was it, 32 billion, and it's a 21% year over year increase. Was that right?
Yeah, a little bit smaller, but I think the key is that sales are starting to accelerate a lot this year. It's been a difficult last couple of years for the industry. Intense price compression led to a lot of operators facing profitability challenges. You didn't really have new licenses enter the market over the last 2 years, so sales were roughly flat. You didn't have much in the way of new markets coming online outside of Missouri and Maryland. So really, the industry's hit a bit of a plateau over the course of 22 and 23 that is changing very quickly over the course of 2024. First, you have the most licenses that were issued this quarter of any license over the last 2 years. A lot of that is driven by many of the new markets coming online. States like New York, New Jersey, Maryland, Ohio, Illinois, Minnesota, and on are really starting to accelerate license issuances. Those 6 states alone are planning to issue more than 3,500 retail licenses over the next 2 years.
Wow.
Outside of Oklahoma today, you have around 7,000 in the US. So when we think about the growth of the sales base and places for like retail accessibility to really expand, it's going to be in a lot of the new states bring on new licenses, contributing large gains to total sales. So this year, you're probably going to have total sales in the range of 32, 33 billion plus, which would put us on a growth rate of 10 to 15% from last year. It's the first time you're seeing real double-digit growth in the industry since COVID. So overall, we're just feeling really excited about what the industry has to offer. We think that while the short term has been very volatile, the long-term story remains intact. Volumes are growing very quickly, and especially seeing it on LeafLink's platform, where more than half of all products sold at dispensaries are sourced. Prices are improving in many markets. Margins are up for operators. Just overall, there's a lot to be excited about in this industry, and it's one of the first times that we can really say that in years.
Yeah, I was gonna say it's been a lot of doom and gloom lately. So this is actually a pretty positive sign. And with that being said, do you see this being a long-term sign of the positive, like we've turned the corner, or is it more of like an ebb and flow? Are we gonna see going forward from here?
US cannabis is very interesting because while you see like the $30 billion of total sales that the industry put out last year, it's really like the aggregation of all of your different state markets, like your California at 5 billion, Michigan at 3, Florida at 2.3, Illinois at 2, and on. You have 11 markets that do over $1 billion in total sales every year, 23 markets that do over 100 million. So when we think about expectations over the next few years, I don't think it's really about what's happening at the national level. It's what's happening in each one of these state markets and how is their maturity changing overall. I would say that expectations of improvements over the next 2 years, like net overall across the country, are going to come true for a few reasons, right? Many of your very mature legacy markets have experienced a lot of the pain of operator profitability challenges and ultimately consolidation. Like over the last year, more than 40% of cultivation license holders in California gave their licenses back to the state. It took off
Wow.
around 30% of total capacity. In Oklahoma, 2,000 growers had their licenses like non-renewed over the last year, a lot of them due to like illicit market challenges. due to the moratorium in the state, that number is going to continue declining. Oregon, just a couple months ago, instituted a new moratorium on cultivation licenses and every type of license outside of retail in the state. So when we think about many of your mature, very challenged markets over the last few years, like they're starting to reach this point of stabilization where you don't have this big push and pull of supply and demand fluctuating prices very aggressively and making it really difficult for operators to respond. On the other end of the spectrum, in many of your newer markets that have been coming online for the last few years, like a New York or a New Jersey, um, they're really ready to start growing quickly. I mean, New York and New Jersey and those two states have been bringing on 3, 4 retailers a week. New York's planning to issue over 1,500 retail licenses. New Jersey's going to issue over 1,000. That didn't really start moving up until like a couple months ago this year. So you're going to see more growth there. You have a lot of optimism out of new states that are ready to launch adult use programs. Ohio's going to issue 400 new retail licenses, many of them to the current medical retailers and to many of the medical cultivators in the state. So you'll have a robust infrastructure to supply that program. Minnesota's planning to issue licenses at a minimum one retail license per 12,000 people in the state. That's going to be another 500 stores there. In Illinois, you have the 200 plus social equity licenses that have been waiting to come online, have just taken some time due to a lot of the capital constraints. But new social equity provisions put in by the state, new access to credit, grant programs are really making it so that stores can really start to come online. So if you think nationally, what the dynamic has looked like over the last few years is over the course of Colorado legalizing in 2014 to many of your early states over the course of 2015, 2016, 2017 coming on, all of them really just build up as much demand as you can through your retail stores, as much as supply as you can through your cultivation capacity. Many of your big legacy markets became very oversupplied in 2019 and early 2020 before COVID. I mean, there were stories of entire warehouses of Oregon bulk cannabis being burned down because there just was too much supply in the market. Um, you then have those states face a lot of challenges over the last few years. At the same time, you have a lot of new limited license, like MSO heavy states across the Midwest and the East Coast. So states like Massachusetts, Illinois, Maryland, Arizona really start to grow and come on. Those states are now the ones that are starting to face a lot of challenges from the cultivation side. Like Arizona had the strongest price declines last year of any market. That was not expected going into the year. You've seen similar softness in states like Massachusetts that a lot of MSOs have recently left. Even in states like Michigan, where pricing has fallen very aggressively on oversupply dynamics. Now we're at like this third big phase where a lot of the newer markets that we've been talking about, New York, New Jersey, Ohio, Maryland, and on, are coming online, are going to bring tremendous new sales to the industry. And it's really been this gap over the last few years that I think has a lot of people like not as optimistic about the long term for the industry. But again, like sentiment has changed, license issuance is accelerating, and total sales are going to expand in turn. And I don't think people are like really calibrating for that enough yet. Like expectations are too low today on the industry, and I think it's presenting a very large opportunity for many of the operators that can access capital, expand, and really enter some of these new markets that are going to contribute most of the growth for the industry.
Yeah, and I think that's really important to talk about the growth and the potential there. The one thing I want to dive into first is, you mentioned how New York is finally coming online, and Illinois has kind of stumbled in the same way with the equity license rollout. Kind of two of the same sort of situation. I know New York, watching that market from a firsthand, saying that Illinois, and some of the other states were kind of the lessons that they weren't going to walk into, and I feel like they kind of walked into a lot of those, and that is in part some of the reason the licensing kind of was slowed in the last few years. Are you seeing that that trend seems to not be being followed in states like Ohio and Minnesota and some of the other states that are coming online? Or is there any sort of data indicating any trends like that?
Think it's challenging to look at social equity across markets nationally. For one, like the initiative for most of these programs has not necessarily been like profitable sales. It's been about giving people most impacted by the war on drugs the opportunity to enter the legal market specifically. Like that was definitely the focus and goal of many of your states that come online. One of the big challenges there is it's very difficult to access capital as a former felon and to really overcome most of those like know your customer KYC, KYB issues. So it's led to many of those like social equity focused license holders having a difficult time accessing the cash they need to really start up their business. Like if you're launching a dispensary, you need a few $100,000 just to purchase inventory for your store, let alone the hundreds of thousands of dollars needed to retrofit a facility or space, hire new employees, like really go to market. Most of these like equity license holders just don't have the cash for that. And that's been one of the main reasons why it's taken a long time for those equity license holders to come to the market. I think states really have learned over the last few years how to mitigate a lot of those complications. Like New York has its state fund, which has gone through some trials and tribulations, but ultimately like is going to give credit to the operators who need it because it doesn't really exist anywhere else for them. You have states like Illinois where a lot of the challenges that you had more broadly in the market, not just in cannabis, but overall capital allocators not having the same environment as they did in like 2020 and 2021 with very low interest rates, very high interest in speculation, and interest in entering an industry where like cash flows are not really guaranteed in the short term. And I think that hasn't necessarily changed a lot, but sentiment around capital into the industry has changed. Like credit spreads have been cut in half over the last year. Equity values are up for a lot of the operators. Part of that has to do with sentiment from like regulatory reform and total change. But ultimately, as we think about it relating to the social equity license holders, they have net more access to capital today, which has led to more licenses really coming to the market. Also, part of that is a lot of the lawsuits that have been fought against, like a lot of these social equity specific programs, have slowed their rollouts. But look, like New York, whose social equity program has been one highlighted in the press like over and over again, like is starting to deliver on a lot of those promises of giving license holders the ability to open stores. Like that is happening. Like 600 plus licenses have been issued. You have a lot of social equity specific license holders in states like Maryland now getting preference. I think a lot of them are going to come to market faster than you've seen historically. So look, like not every cannabis program nationally has been rolled out in the best way possible, but I do think that a lot of times for a lot of the social equity programs in particular, like the main motivation hasn't necessarily been profit. It's been a lot more about increasing accessibility to the people who don't really have it today.
Yeah, absolutely. And I appreciate you elaborating on that. One of the things too that it was you mentioned too is like consolidation in certain states and state markets. And not to keep it all entirely focused on equity, but I know in past states that a lot of times the equity individuals are the ones that tend to be consolidated often early. Certain states, if you look at it, seems to be more often than not. Do you know if that what the trend is looking like now when in terms of consolidation? Is it still looking like a lot of the equity players are being taken out during that period, or are they remaining viable and staying for the long haul?
Yeah, I think it depends a lot on the market to market dynamics. We could talk about consolidation holistically, where one of the big challenges in the industry today is that prices in many legacy markets are too high to support or too low to support the operations and high cost structures of many of the cultivators there. 70 to 80% of cultivators across the country today are unprofitable. Like, think about that.
It's insane.
Most operators upstream just do not make money. And when there's very limited access to capital over multiple years of time, it just leads to strong consolidation in many of these industries, especially upstream. Like we talked about it a little bit with some of the cultivation licenses out in the legacy markets. But like the way it's really materializing is through license givebacks, and like mergers for survival. Like ultimately,
Yeah.
if you can have a bigger cultivation facility, your marginal costs do not grow very quickly. So you're very much incentivized to just group together assets as much as you can. Thinking specifically to social equity, the dynamics matter a lot state to state. In some states, the social equity license holders have to maintain majority ownership, so they're selling parts of the license to access some capital. There's some states where you have seen large consolidation of the social equity licenses. Arizona is a good example. You have 131 vertically integrated licenses. The state, like a year and a half ago, issued 26 new social equity licenses specifically only at retail. 24 of those 26 licenses have been purchased by the current vertical license holders. So there is consolidation on the social equity side. I think a lot of that is driven by different factors, right? Like one is the opportunity for immediate exit with profitable, limited necessary infrastructure requirements. Like as we talked about, it's very expensive to stand up a new store, hire new employees, build out all the inventory. So for a lot of license holders, like it's just a better opportunity to sell the license if they can. It also makes it so that those license holders have an ability to partner and tie together with some of the larger infrastructures. Like an example of that would be in Connecticut, where you had a lot of social equity licenses issued, particularly at retail. And then they grouped up with many of the large MSOs that own cultivation in the state because there wasn't enough plant material to support all of those operators. So like they essentially had to go vertical with many of those players. So what we've seen for sure is that many of the nuances driving consolidation across the industry for equity licenses or not are very nuanced by market. And for some of them, it's driven by price and poor operating conditions. For others, it's driven by like license opportunities and really the ability to just like enter the market in a more fruitful way.
Interesting. And if looking at all the numbers, obviously it's a little bit subjective, but as pragmatically as possible, what states are you saying are doing it the best at this point? Which states are really kind of setting the example for the rest of the market to look at?
So thinking about growth for the next 2 years, it's coming from a very specific consolidated place, like the 6 states that we've been talking about issuing the most licenses, New York, New Jersey, Maryland, Ohio, Minnesota, Illinois, are going to contribute more than 60% of the sales growth over the next 2 years. I think you're going to have a market that's doing over 40 billion a year in sales by the end of 25. Almost all of that growth is going to come from those key markets. When we think about states that are rolling out programs in very successful ways with the right types of structures and the right regulations, I think a lot of the newer markets coming online have learned lessons from those over the past. One I would highlight is Missouri. I think Missouri did an amazing job rolling out its adult use market in February 23, and it did it in a few different ways. First, the vote happened in November. The licenses were ready to go for adult use in 3 months. That's one of the fastest times from vote to legal sales of any market ever. The second is that all medical license holders in the state were licensed for the adult use market as well. So instead of when many states roll out an adult use program, they bifurcate the licenses. Missouri made it so that all of the medical infrastructure that had built up to supply the market could adequately supply the adult use market, and they certainly needed it. There was not enough cultivation capacity for the legal market. It caused bulk prices in the state to go from like 1,000 a pound to $3,000 a pound. And a lot of that has been right-sized over the last year, but ultimately, like you just needed that infrastructure to support a robust adult use program. The last is municipalities are not allowed to ban cannabis businesses from entering in them. So you have a lot of density allocation of stores in Missouri. So a lot of stores are spread across the state in a way that makes it so that almost everyone has a store pretty close to them. That's very different than a lot of other states. Like California, we always think about as the state with 1,000 licenses that has the most sales in the country. Two
Impressive.
thirds of cities in California don't even allow a cannabis business. And it makes it so that there's places that you don't have a cannabis business within hundreds of miles of you. You're very unlikely to enter the legal market if you don't have a store anywhere close to you. So I think Missouri did a really good job in terms of spreading out the stores across the state, making them so they could serve the adult use patient, and letting them come to market very quickly. And all of those things made it so you didn't have the buildup of a robust illicit market. You didn't have a lot of the challenges that adult use operators have entering a market completely new. Like you had your very strong license holders, like your Good Day Farms, your Greenlights, your Propers, start to acquire more assets in the space. Missouri is also very interesting from an M&A perspective. More than 70% of the licenses have changed hands since the beginning of the market's time. That's one of
Wow.
the most aggressive M&A paths of any state, but it's also one with very healthy dynamics. Like if you continue to consolidate either stores downstream or upstream cultivation, you make it so that your profitability is a lot easier, letting you offer like lower prices and better products to your end consumer.
Yeah, I who would have thought going into it that Missouri being called a legal marijuana mecca would be, a thing. But you're right. It really has kind of, shown up a lot of people on the coast and, places that thought they were going to do it better. Yeah, it is kind of crazy how Missouri really has laid out a game plan that, it's just, there's a lot of factors, but the one that really sticks out to me is the opt-out laws. Like you said, like it's just amazing what happens when, obviously you want to give the rights to the local government and the people and stuff, but like at the end of the day, those opt-out laws are killer. And we're seeing New York, California, like you said, other places. And it's amazing what happens when people actually have legal access to cannabis nearby.
Yeah, you're right. And even on top of that, you're not allowed for like large municipal excise taxes. So
Huge.
in a state like Illinois, on the border of Missouri, you have excise taxes that typically go into like the 35-40% of the total
Yeah.
product. In Missouri, it's very static at under 15% on all transactions. It makes so the products are a lot cheaper, helping build like more interest and accessibility to the market for legal consumers.
So if any lawmakers are listening to this, stop having opt-out laws and make your taxes better. Oh man. So Ben, one thing, obviously you guys being a cannabis industry report, you were going to have to touch on the possibility of the DEA rescheduling looming over. And this report came out on April 29th. We're speaking about this on May 5th, not May 5th, May 1st. And, on the day in between the report coming out and today, we had a lot of big news going on with the DEA rescheduling. You touch about it obviously in the report for folks who haven't checked it out yet. What are the implications that what we're now looking like? We're heading over to Schedule 3. What's it going to look like for the cannabis market and potentially capital access?
Yeah, so I'll say sitting here on May 1st, we don't know a lot for sure. It's been reported that the DEA intends to move to Schedule 3. That hasn't been confirmed fully. We don't know what the exact guidance is going to be on state regulations, changes to federal taxation structures. Like there's a lot to still be assumed. But there's a few areas that we can feel very confident about and very excited for the future of the industry. The first for sure is going to be the removal of 280E taxation. If the DEA does indeed move cannabis to Schedule 3, you no longer have to pay 280E taxes as a cannabis business. What that means is today, as a cannabis business, you're taxed at your gross margin line. So for the average business in the industry, you're probably doing something around 40 to 50% gross margins. You're taxed at 30% of that, and you're paying like a pretty hefty portion of your revenue in taxes. The average tax on a cannabis company is 3.5 times the S&P 500 average. So we think about these companies are significantly overburdened by taxation requirements, most of it because they can't deduct any of their like standard business costs below their costs of the actual product. That's going to change with Schedule 3. It's going to move to typical taxation structures where operators are able to deduct like any of their typical business expenses like utilities, rent, employee costs, marketing expenses. Like there's all these parts of the industry that just haven't really developed because they're very expensive from a taxation perspective. The removal of 280E taxes is likely going to add $2 to $3 billion of additional cash flows into the industry on a yearly basis. Like, I don't think people
Huge.
understand the magnitude of that. Like, that's more capital into the industry from like a cash perspective that's been invested in all of cannabis over the course of like the second half of 22 and throughout all of 2023. So it's going to have a tremendous impact on companies' balance sheets, ability to raise money, cash flow metrics, profitability, like just overall it's improving the industry. At the same time, there's a few other like ancillary impacts from the 280 taxation change. One of them is that many operators in medical markets are starting to apply for tax refunds. We saw it during the last earnings cycle, where Trulieve and some of the other big MSOs reported like a lot of success in those tax refunds. Like someone like Trulieve was able to get almost $140 million in refunds back on cannabis sold in medical markets. Like that's likely going to continue as a trend across markets. Most of the customers that I've talked to on LeafLink's platform are interested in ways to get tax refunds for any sales in medical markets. Like I would probably bet that you get more investment into the cannabis industry from the federal government in the forms of tax refunds and tax abatements from the change in policy than you do from investors filing in over the next year. So there's a lot of excitement there.
Yeah.
So that's for sure your biggest change.
And so where does that lead? I've just as a freelancer, I have already gotten a few more inquiries than I've probably gotten in the last like year and a half with this dry market. What does it mean for the job market? Are we going to see a lot more investment into standard business expenses, either being investment in services, assets, and individuals? Do you think that's going to be on tap soon?
They're essentially 30% cheaper now. You get to deduct them as part of your taxes. So for many operators, like it's just lower cost to use the same services that you've had available to you previously. So that's either going to come in the form of people looking to spend money through channels that probably get them a better ROI today than some of the alternatives they've been using. Another aspect of it is many ancillary providers and services to the space can offer higher quality, especially if they're plant touching, because now they have improved cost structures and profitability. So I think that overall, you're going to get improvements to the industry, especially from like a financial perspective, but also to your point from like employee and talent perspective. Like companies are going to have better margins. They can likely hire more people to facilitate more growth into the industry. That's been one of the big challenges over the last couple of years is with all of the short-term volatility you saw, especially on pricing, like everyone had to roll out the recessionary playbook, cut expenses as much as possible, preserve cash, reduce working capital. And for a lot of these companies, it was exiting markets that they didn't necessarily know would make sense or not in the short term, laying off as many people as they could to right size cost structures. And like that's going to look very different when you get an extra 10 to 15 points on your margin just from the removal of 280E. So I think a lot of goods to come. There's a few other dynamics that you get from the shift to Schedule 3. We don't know what regulation on the cannabis industry is going to look like. What I would guess is that most of like the state regulation of the cannabis industry is going to remain at the state. The DEA is not large enough to adequately like police and regulate the cannabis industry across all of your different markets in the country. That's your most likely, but there's a large range of possibilities. Like it's possible that medical cannabis is going to be regulated directly by the FDA. Recreational cannabis will remain at the state level. And we reach this like point of questioning and clarification and change where for the most part, like medical and recreational sales have been regulated roughly similarly at the state level. Like you obviously have some changes for the type of product and SKU, but you don't have entirely different regulatory pathways. Like that could develop from Schedule 3, we don't know. So that's one of the other key considerations to look out for. Another is just overall, you have improvements in sentiment to the industry. Like if cannabis is a Schedule 3 product, you probably get some changes in like financial services companies interesting like interest in servicing the industry, the ability and access for capital probably improves a bit. I don't think you get like access to the US capital markets by cannabis moving to Schedule 3. It likely still remains as like a federally illicit product, especially for adult use sales. But it's definitely a sign of progress and change and something that we in the industry should be excited about. A lot of these changes are likely to get implemented around the election. So current expectations on timing is that the actual shift to Schedule 3 would be towards the end of the year this year, with the next like 5 to 6 months really being a big comment period, going over different scientific reviews, just really evaluating like what it means to move cannabis to Schedule 3. But overall, I think people are pretty aligned on that being the plan.
Yeah, so a little bit of uncertainty, but a lot of positives to look forward to, and really could shape the election in some people's minds and hear where the laws get enacted. So really big development. Appreciate you diving in on that, Ben. And kind of taking it just a little bit further. Looking a bit further out here. See it in the report. What was it by 2030? You're expected to see the market go up to about 60 billion with a CAGR of around 11%. Is that correct?
Yeah, the industry has tremendous opportunity. And again, I just think that the last couple of years have been challenging. It makes people under index the opportunity sitting in front of us. There's huge growth still yet to come for this industry. Like four of your five largest states by population, so states like New York, Texas, um, Florida, North Carolina, like still don't have legal programs. Your largest population centers are likely to drive the vast majority of your sales over time. So as the industry liberalizes and you start to get more legalization, especially at the state level, you're going to get large changes in the amount of total sales into our industry. So like for me to say that sales are going to roughly double over the next like 5 to 6 years, I believe is conservative. I think that as you get more retail accessibility, as you get more states launching legal programs, as you get more interest at the state level, like you're likely to have huge changes in total sales. Like for instance, I don't think people are ready for what happens if Florida actually legalizes in 2024. I don't think it's going to happen. 60% has never ever happened in general election for cannabis. Uh, Adult use, it's happened on the medical side once in Florida. But I do think that you probably don't get it. If you did get it, Florida would instantly become the largest market in the country, larger than California. You'd likely license all the medical stores that are in the state for adult use. You have 180 million tourists a year to the state. It's the most of any state in the US. In states like New York's going to be a multi-billion dollar market by next year. And people aren't ready for that because it's just been such a challenging last couple of years. But as the state continues to open new stores, like that's the main driver of new sales. As you have more accessibility to retail, you'll have more total sales. So if the state really does achieve its plans of getting over 1,000 stores by some point next year, like that's gonna drive a market that's doing $2 to $3 billion from today doing like a few like 10 to 20 to 30 million a month. It's the same for New Jersey. It's the same for states like Maryland that are now issuing another 500 plus licenses. There's just a lot of opportunity for our industry long term that we haven't fully calibrated for. So like I think sales are likely to expand very quickly. We don't even know what's going to happen if you start to get more accessibility outside of dispensaries. Like today there's 10,000 stores where you can go in and buy regulated cannabis product. There's 2.3 million locations where you can buy liquor either on-prem or off-prem. So once we get that type of scale, like the elasticities that you can play with in terms of like product portfolio and pricing and consumer targeting change very dramatically and really just open up the market holistically. So you're going to get a lot of growth in this industry going forward. It's going to come from states that are going to launch legal markets with large populations. It's going to come from many of the states that have legal programs today that are expanding on the retail side, and ultimately just from a change in overall policy liberalization in the U.S.
Man, a lot of optimism. It is great to actually see that and actually looking forward to this market. That's great to hear. Ben, for anyone who, first of all, doesn't see LeafLink's reports or know Ben's work, I got a chance to work with him a little bit before, and he was a great reputation for writing some of the best deep dives in analytics in the market. And I've got to agree. So if you haven't checked out any of Ben's stuff yet, be sure to check out this report and everything else he's done for LeafLink and just any other data reports. If you see Ben's name on it, check it out. So that said, we obviously could dive into a whole lot more from this report, but I want to be respectful of your time. So let's kind of bring it home on this. Is there anything else that we haven't touched on yet that you think the listeners need to be aware of from the report?
Yeah, thank you so much, Andrew. I really appreciate you saying that. Look, again, I don't think people are ready for the type of growth that's to come for the industry. It's been a very difficult last couple of years, but if there's anything you take away from what I've said so far, it's that there's a lot of growth to come for our industry. It's coming from many of your new markets. It's coming from many of your mature markets that are starting to open up opportunities at retail. And ultimately, it's going to be driven by US national policy liberalization. LeafLink, we are very excited for the industry to continue to grow. We feel very well positioned to help support operators across the spectrum. We are the commerce platform for the industry. If you're a retailer, we are the place to buy your product. If you're a brand, we're the place to sell it. More than half of all wholesale transactions go through our platform. I think it gives us a really good sense of how markets are changing, why they're changing, and how to best support the operators through those changes. So for us, the goal is to service your needs as an operator, make your business as easy as it can be to run, and ultimately provide you a lot of the value add products and services that you need to do it.
Awesome. Well, thanks so much, Ben. Where can people get the report at?
If you go to leaflink.com, it will show up on a little banner right at the top. So feel free to go there. And then you can go into our blog for a lot of different data talks, deep dives on different topics, just to get a better understanding of both the industry, the product set, and what LeafLink does to help.
Sounds good. And you can check them out on social. You guys are at LeafLink on everything. Is that right?
Yeah, correct.
Cool. Well, follow them on social. Check out the report. Ben Burstein, analyst for LeafLink, as well as the author of the Q1 2024 report. Appreciate you so much for taking time and diving in on this and providing some market optimism that we haven't heard in a while. So thanks so much. And folks, be on the lookout. Looks like we might have some good news ahead.
Thanks, Andrew. Thanks for everything you do.
Yeah, my pleasure. Thanks so much.